Okay, so Chapter 9, Plant Assets. Remember that the PowerPoint says Chapter 10, but it's Chapter 9 in our book. Okay, so we've talked about plant assets before. They're not anything new, but they are long-lived assets that benefit operations. All right, and they're actually used in operations. That's key. Assets that are not used in operations, like long-lived assets that aren't used in operations, are generally classified as investments. So plant assets that are used in operations go in the plant assets section. All right, and we already all know we've got land, buildings, equipment, furniture, fixtures, automobiles. Equipment might be computers, generators, all types of things. Okay. We classify the cost of a plant asset as an asset. All right, and then we depreciate over its life as it is used up. All right, and we do that because depreciation expense is matched to the revenues that it helps to generate. All right, so really what depreciation is the systematic allocation of the cost of an asset to expense. All right, so as we use it up and as it benefits us and it helps us generate revenue, we match it to that revenue through depreciation expense. Sometimes an asset might actually increase in value, but we're still going to depreciate it. Like a building might actually increase in value, but we're going to depreciate its cost. All right, so cost. All right, remember that the cost principle applies. And the asset is carried on the books at its historical cost less any accumulated depreciation. And if you recall, we've talked about book value before. Book value is cost minus accumulated depreciation, and that's generally what shows up on the balance sheet. Okay, so we've got a variety of things. Land is typically going to be, cost of land is going to be its price plus broker's fees. Plus survey, plus any property taxes paid. And I'm going to say I'm going to change this to any back property taxes. Plus title fees. And then plus cost of clearing the land. So if you buy a piece of land and you have to clear it off and get it ready, that's part of the cost of the land. If it happens to have an old building on it that you have to clear off, that's part of the cost of the land. If you sell any scrap from the old building, then you reduce the cost of the land by what you got for selling the scrap. All right, land improvements are separate from the land. Okay, these might be things like a fence, lighting, a parking lot, a sidewalk. That stuff is all separate from the land. If you remember, land we don't depreciate because it has its life is unlimited. Okay, we can't put a life to land, but land improvements we can put a life to. So if you recall, let me move this down. Type that in here. Land is not depreciated because it has an unlimited life. And we can't divide by infinity. Land improvements are depreciated. All right, so here's an example. Okay, so Smart Touch Lane purchased land on August 1st of 2015 for $50,000 with a note payable. Other costs related to this transaction include $4,000 in delinquent property taxes, $2,000 in transfer taxes, $5,000 to remove an old building, and $1,000 in survey fee. The additional costs are paid in cash. Okay, so when they're recording the cost of the land, we're going to have a debit to land. I don't know what I just did. We're going to have a debit to land. I'm going to actually make it two separate entries. And then the note payable for the $50,000. And then all these other costs are also going to go to land. All right, so the $4,000 in delinquent taxes, the $2,000 in transfer, the $5,000 to remove the old building, and the $1,000 survey are also going to be part of the cost of the land. All right, and I could have just done that in one entry. I could have said land for $62,000. All right, here, I'll write it out actually. I could have done land for 62, note payable for 50, and cash for 12. Okay, so here's the total cost of the land was $62,000, and then they went ahead and did one entry. All right, capitalizing, they used a new term here. Capitalizing means that you record something as an asset account. Means to record something as an asset. All right, means you're putting it on the balance sheet as an asset. All right, what's next? Buildings. Building cost. Anything needed to acquire the building and get it ready for use. So you might notice over here, architectural fees. This is for one that's constructed. So the architectural fees, any building permits, contractor charges, payments for material and labor. That's when they're building one. In this case, they purchased one. So brokerage fees, any delinquent taxes, any renovation costs, but anything to acquire or construct it and get it ready for use. All right, machinery. Basically the same thing. Anything to purchase, ship, install, and test. Okay, so basically anything you have to pay to get it to you and get it ready for use. All right, furniture and fixtures, same basic thing. Furniture and fixtures are your office furniture, you know, couches, desks, tables, filing cabinets, chairs, whatever the case may be. Those are typically going to be the purchase price, and then, you know, shipping is included in that. So anything to purchase it and get it to you. Uh-oh. There we go. All right, sometimes you may pay things in a lump sum. We're going to skip this, okay? You do not need to know lump sum. But basically, you allocate it based on fair market value. Allocate purchase price based on fair value. We'll do this in intermediate if you're an accounting major. Okay, so now we have capital expenditures versus revenue expenditures. Okay, a capital expenditure will last a period of time. All right, it's an asset purchase. Well, it's not asset purchase. It's an asset repair that increases the efficiency or life of the asset. Okay, so for instance, if I have a truck that I've had for 5 years and I think it's only going to last 2 more years, but I put a new motor in it and now I think it's going to last another 5 years, then that's a capital expenditure. Okay, a revenue expenditure is just repairs and maintenance. My gosh, I'm gonna go back and spell check everything. Repairs and maintenance required to keep something going. And it would be repairs and maintenance expense, or repairs expense. I'm just gonna say that one. All right, the capital expenditure would be actually debited to the asset. Okay, so here are some examples. A capital expenditure, you would debit an asset, and a major engine or transmission overhaul, modification of something for new use. You add storage capacities, like maybe you build an extra room onto something. Anything that basically increases the life of the asset. A revenue expenditure is like a repair of a transmission, oil changes, new tires, new windshield wipers, or a new windshield, a new paint job, just things that don't really affect it but keep it going as it should be. All right, I'm going to post that and then we'll come back and look at depreciation.